Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Lithium stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Lithium has positioned itself to become one of the world's most sustainable lithium producers. The company is headquartered in Toronto, Ontario, Canada, and was founded in 2016. It went public in 2016 and trades on the Pink Sheets, TSX Venture, and Deutsche Börse. As transportation becomes more electric focused, the lithium industry is expected to face a significant surge in demand. This company expects to meet this demand with energy efficient facilities that minimize fresh water consumption and carbon dioxide production. They also partnered with CATL. This is China's largest producer of automobile batteries. CATL also bought $8.5 million of this company's stock, so they definitely want to see this company succeed. This company claims its lithium is cleaner and purer than any other company. If this statement is true, it gives them a really big competitive advantage. Let's get started with the model. This is a small cap company, 314 million market cap. They're trading at $2.26 a share, and they have 139 million shares outstanding. We're going to look at the ticker that trades on the TSX Venture, so all the numbers in this video are in Canadian dollar. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So they're pre-revenue, so they have negative free cash flow each year. Net income is the profit and loss on the income statement. It's revenue minus expenses. That was negative in 2017, positive after that. You may be wondering, how can they have positive net income with no revenue? I'll show you when we get to the income statement later. As I mentioned, they're pre-revenue, so they have zero revenue each year. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue, and the difference between those two numbers is the gross profit. Their gross profit is really small, negative $79,000. Last year was negative $90,000. They don't have any revenue, so they don't have much cost of revenue. Below that is operating expenses. That's where most of their expenses are. They had $5.6 million of operating expenses in 2020. Operating expenses are marketing, research and development, depreciation, things like that. Below that is their operating income, which of course is negative every year. They also have a small amount of interest they pay in their debt, $3,000. Last year was $6,000. Below that is other income and expenses. This is why they have positive net income most years. If a company buys an asset like a building or piece of machinery and then sells it a few years later because they realize they don't need it, they may actually make a profit on the sale of that asset. That's what happened with them. They sold off some of their assets and they made $16 million in 2020, $9.4 million in 2019, and $9.5 million in 2018. They had negative $2.2 million in 2017. So they do have positive net income. But that's not how you grow a business selling off assets. You grow a business by bringing in revenue and managing the expenses that are tied to that revenue. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company loses or generates from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit and loss. It's not actual cash. So they did have positive operating cash flow in 2018, negative in the other years. Then you have capital expenditures, which are investments in property, plant, and equipment. Operating cash flow minus CapEx gives you your free cash flow, and that's negative every year. Since they have negative free cash flow, they need money from somewhere to run their business. They're doing it mainly from capital stock. They issued $51 million of capital stock in 2017, $8.2 million in 2020. When a company issues capital stock, it increases the shares outstanding, making your shares less valuable. Let's look at the capital structure. They have $67 million of equity and almost no debt, so they're 100% equity. Their net debt is negative $33 million, and their WACC is 10.22%, and that's the discount rate we're going to apply to the future cash flows. We estimated 7 years of future free cash flows, We also estimated a terminal value, which is all cash flows past year 7. That's $622 million. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $357 million. We divide that by 139 million shares. And we get a calculated stock price of $257. They're trading at $226, so they're trading at a 12% discount. It's a buy according to the model. It's really hard to value a company that's pre-revenue. The way I valued this company is I estimated their revenue would be $500 million in 2027, and roughly 10% of that would convert into free cash flow. So that's how I got $47 million in 2027. And the free cash flows from prior years just backed into that $47 million. If you think their revenue will be more than $500 million in 2027, then your valuation will be higher than mine. But if you think they're going to be less than $500 million, then your valuation will be lower than mine. But as you know, the stock market is not based off of how well a company is doing financially. It's based off of supply and demand of the market. If investors feel this company has a great future, they'll bid the stock price much higher than where it is. If investors think this company will struggle in the future, they may push the stock price lower. Understanding market sentiment is the hardest thing to do in the stock market. One analyst priced this stock at $3.45. 5 more analysts priced this stock, and their average price target was $4.44. The low estimate was $3.90, the high was $6. This is the stock price since it started trading, and you can see the stock price jumped up at this point but came back down. But it looks like it was really driven up a few months ago. It's come down a little since its peak. It looks like it broke through $3, but it's come back down. That happens a lot in the stock market. When there's news about a company, investors get really excited and buy the stock, pushing the price higher. But when there's no news for a while, or the company doesn't come out with amazing financials, investors sell off and take in their profits and push the price lower. This is the stock price the last year, so it was really low at one point, looks like under $1, so you could have tripled your money. But it seems like it could be a good long-term hold. I think this company has a great future. It just may take a few years to make a good return. You never know when the stock price will jump or not. This chart shows the demand for lithium from 2016 up to the estimates of 2026. Here's the high estimate and here's the low estimate. So even the low estimate, it seems like lithium is going to be growing a lot in the future. But if it does hit the high estimate, the demand can be off the charts, and this company could be sitting in a really nice spot. One of their big projects is a 3Q project. This is in Argentina. It does take a lot of time to find these areas, get approval, so it's an expensive and time-consuming process. But if they can pull as much lithium as they say, they can make a lot of money with locations like this. They're saying they can make 8% of $1.1 billion. So that's about $88 million off this one project. They have a pretty high beta, 1.84, so the stock moves almost 2 times the market. It's a little volatile. The stock has gone up over 400% in the past 52 weeks, while the S&P 500 went up 41%. The 52-week low was 44 cents, the high was 388. And the stock is trading below its 50-day and 200-day moving average, so it seems to be on a downtrend. About 400,000 shares are traded each day on this stock. Of the 139 million shares outstanding, 116 million are on float, 12% are held by institutions, and hardly any of the shares are shorted. In the past year, this stock has gone up over 400%, its industry 15%, and the market 44%. But in the past 3 years, this stock has gone up only 27%, while its industry went up 55% and the market 28%. And this stock has struggled in the past 90 days, down 31%, while its industry is up 4% and the market is up 6%. In the past 5 years, their annual earnings increased 80%, its industry 28%, and the market 13%. In the past year, their earnings grew 945%. That's only because they sold some of the assets on their balance sheet. Their industry is up 107% and the market is up 12%. If you invested $10,000 into this company when it IPO'd, you'd be at $14,000 today. That's a 40% total return. But your $10,000 investment would have been worth over $20,000 a few months ago. The biggest shareholder is BlackRock at 7.5%. Then 2 executives at the company own 3.5% of the stock. 1832 asset management, and commodity capital. Let's look at their financial ratios. The average PE in the market, 33. The median is 22. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They're at 23.7. So investors are paying $23.70 for $1 of earnings. We can't look at the price to sales because they have no sales. Their price to book is 4.7, which is between the market median and average. They have negative EBIT, so they have negative return on invested capital, negative interest coverage ratio. Their ROE is 19.9%, and their current ratio is 11.2. They have a lot of current assets relative to their current liabilities, and their current assets are mainly cash of $33 million. These current assets are as of their 12/31/2020 balance sheet. Also, in the first quarter of this year, they did another capital raise of $30.2 million. They sold warrants to investors. Warrants are just long-dated options. The company does seem to be well capitalized. They had negative $6 million of free cash flow, $30 million of working capital, plus that other $30 million of warrants, so they're well capitalized. The best way to look at ratios to compare them to companies in the same industry. I've done videos of 7 companies in the same industry as Neo Lithium, and if Neo has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. So they're better in PE because of those asset sales. We can't look at their price to sales ratio. They have a better than average price to book. They have a really high current ratio. They have a good ROE. They have no debt. And they're a really small company at 314 million market cap. Almost the smallest on this list. American Battery is a little smaller. So to summarize, I have them trading at a 12% discount, but I think this company has a really bright future. If their lithium is as pure and efficient as they say it is, and if EV cars keep growing like they do, this company is poised to be a monster. Of course, there's competition, so you never know what will happen, but this company is really positioned well. I rank their free cash flow as 1 out of 10, their revenue 1 out of 10, and their ratio 7 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.